Hello, Silicon Valley. So welcome to Idea to IPO. Hello, my name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many, many years. We launched on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 400,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 3,900 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. Thank you. Thank you for all your support all these years. We hold venture capital panels, legal workshops, networking events, and more. We hold an event every day of the week. Check out our schedule at ideatoipo.com. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant, stuff you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is a global aspirational ecosystem that attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley or the greater San Francisco Bay Area? Who here was born and raised in Silicon Valley or the greater San Francisco Bay Area? Two of you. Well, welcome. So whether you were born and raised here or just arrived last night, it's important for us to provide multiple channels for you to meet people, build relationships, and grow your network. With regard to value, we want to make sure that we provide value at each and every one of our events. Not just value for your money, which is important though, because many entrepreneurs are struggling financially. So we make sure our events are free or affordable. And if you cannot afford the cover charge for whatever reason, come talk to me and we can work something out. And at most of our speaker events, we make sure that we provide a delicious buffet. Is that a delicious buffet? Well, okay. How about 10 of you think so? I appreciate that. It's always the same 10 people for some reason. But I want to thank Procopio for sponsoring that delicious buffet. So let's hear it for Procopio. More importantly, though, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable resource. Anyone here getting any younger? Besides our moderator? Maybe our panel and this young man? So when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. We have many partners that help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, and lots of other players in the Silicon Valley startup ecosystem. Tonight, we're grateful to Procopio for hosting us once again in this beautiful venue. Is this a beautiful venue? So let's hear it for Roger and Procopio. Would you like to say a few words? Just a few.
I thought you purposely, cut the mic.
Not yet.
Well, welcome everybody. It's fantastic to see you here again tonight, and welcome to the panelists. I guess I do have to pay for dinner, so I'll say a few words about Procopio. We're a full-service law firm, started in 1945. I head up our emerging growth and venture capital practice group. So in our group, and me personally, I deal with companies from inception all the way through the exit, mainly M&A, but IPOs hopefully will come back one of these days. That is about all the time that Rob allocates. So thank you very much, and looking forward to a great event tonight. Thank you.
And just to clarify, Roger was not a founder in 1945.
Somebody asked me that.
I wonder why.
I obviously have not aged well.
A few of our other partners are here tonight. I would like to have them also say a few words. Let's hear it for Frankie and Sushi in New York Life. Applause.
Hello, everybody. My name is Frankie Dong. We're here from New York Life, and this is my business partner, Sushi. If you guys get funded, you guys need life insurance. It's the foundation of wealth. Come talk to me. My table's right over there. Thank you.
Next up, we have Salima and Hapio. Applause.
Thank you so much. My name is Sulaima, and I am the CEO and founder of Hapio. And Hapio is the first spam filter for corporate meetings. So we work with public listed companies who really want to make sure that no one spends a second in a meeting that is not relevant for their employees. We work with the biggest aviation company in the world, the biggest law firm, the biggest shipping company, the biggest pharmaceutical, and it's a VC-funded startup, and we are located here in Palo Alto. So if you want to talk more about meetings and productivity, come talk to me, and my table is in the corner. Thank you so much.
Though our local mission is to support entrepreneurs here in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we maintain a robust YouTube channel, youtube.com/idea to IPO. Go check it out. We have tons of videos there. And this rich, valuable content is available on demand, anytime, anywhere, totally free of charge. In this endeavor, we partner with Tim Jaggers, one of the top professional videographers and digital marketing experts in Silicon Valley. So let's hear it for Tim. Applause.
Thank you, Rob. Thank you, everybody. So I'm Tim. I've been making videos for a really, really long time. Turned into a career. I launched my own production house, Pacific Bay Media. I'll be over here if you have questions about production. I do everything from events to pre-production, production, and post-production for all kinds of shoots, mostly informational, web-based content. Yeah, so if you have any questions for me, I'll be over there, and I'd be more than happy to talk later. Thank you.
So here's the schedule for the rest of the evening. Our panel will hold a brilliant, compelling, dynamic, entertaining, and scintillating discussion. Right? It's a given. Just at 8 o'clock, we'll open it up to questions from the audience. That'll take us to 8:30 p.m. At that point, we'll end the program. Stick around, network, socialize, and connect. There is an after party. Here are the possibilities. The Rosewood. Yeah, I know it's Thursday night. The patio, or pizza my heart. But more on that later. So without further ado, I'm going to hand it off to our distinguished moderator, Roger Rappoport, partner at Procopio. So let's give it up for Roger and our panel. Applause.
We've got a very distinguished panel. I'd like to just go down the panel really quickly and get an introduction. Maybe you can just tell us a little bit about your background, not necessarily about the fun, a little bit about your background, what you did in a prior life that got you to being an investor, a VC. Karen, let's start with you.
Thank you. Thanks so much for having me here today. I'm Karen Roeder Davis. I'm a managing partner at Entrada Ventures. Prior to Entrada, I managed a portfolio of deep tech initiatives at Google X, or X, formerly known as Google X. It was my second tour of Google. My first tour was pre-IPO, where I helped to grow the business from both a legal and sales operations perspective, and then a new business development perspective, and actually wound up managing the internal operations for Google's IPO. From there, went on to advise a bunch of startups, wound up doing corporate venture capital at GE Ventures, so on the industrial internet side. And then was the first business person in at a startup that was the first digital twin for transportation networks. That was, lo and behold, acquired by Google, which brought me back to the mothership there. I also am an outside independent board director previously for Innovize, which is a water software and analytics company that was acquired by Autodesk for $1 billion a couple of years ago. And serve on the board of Shift4 Payments, a public company, as well as 360 Learning, which is a corporate collaborative learning and skills development platform. So thanks for having me.
And we found out that we were probably at the same law firm at the same time.
I left before, but yes, we crossed.
Yeah.
Just crossed.
Schwark.
I'm Schwark Satyavolu. I'm general partner at Trinity Ventures. I'm an engineer by training. Started my first company back in '99. We eventually took that public 13 years later. I then started a second company. This one we sold to MasterCard. I ran their global rewards and loyalty business around the world. And then I went to an identity theft protection company called LifeLock, which was already a public company at the time. We took that company from at 800 million to 2.5 billion in 18 months, sold it to Symantec. And then one of my investors in my second company wanted me to join venture capital and actually help build out a fintech practice for them. So I joined Trinity Ventures at that time, and I've been there ever since.
Great, thank you. Sabrina.
Hi, I'm Sabrina. I'm also a mechanical engineer turned venture capitalist. I started out my career, actually had my first patent pre-college of something I wanted to bring to market. Did that startup, then joined a new startup that actually got acquired by Boston Scientific. After that, went to go work at Apple, and that's where I built the bulk of my career. Became very intimately aware of all of the hurdles that arise from bringing a product from very initial inception all the way through mass production. Learned everything I could, then started my own business, was able to bring my product to market in under 6 months. It was a medical device, which is very exciting, and it was right during the time of COVID. And so I think a lot of the expertise and skills that I've built throughout my career so far have been in the realm of navigating supply chains and understanding the hurdles within manufacturing to actually get things to the finish line. And so at my firm, Omni Venture Labs, myself and my co-general partner started that this past year. And our key value to our portfolio companies is that we understand how to navigate both from the startup side and also from the end company big tech side of the whole sales interaction, and figuring out how to find product market fit very early is something that we really specialize in.
Great, thank you. Ekta.
Hi, everybody. I'm the CEO of UFirst Capital. My name is Ekta Dang. I've been in the Valley for the last 21 years, and like many of us here, I'm a techie turned VC. So by way of background, I have a PhD in physics. I had a long corporate career, changed roles across several tech programs, and then was part of Intel's investment arm before starting our own firm and fund in 2018 called UFirst Capital. We feel we have flipped the venture model by first understanding where the lacunas and opportunities lie in the big corporate world, and then bringing in the right kind of innovation to them and filling those lacunas. With our firm, we've worked with several corporations, Mitsubishi Electric, Nisho Electronics, Ricoh, and about 20 such names, and gone really deep into understanding what they should be strategizing in terms of their innovation requirements and what they are actually doing and trying to fill in those gaps through innovation from the startup world.
Thank you, Ekta. Evangelos.
Good evening to all of you. I'm the managing director of Synapse Partners. I've been a VC for over 20 years now here in the Valley. This is my third firm. I've always been investing at the intersection of enterprise software, data, and AI, a field that I know quite well. Before becoming a VC, I ran 2 startups, and in between the startups, I was a general manager at IBM. And before that, I was an engineer. I started my career actually at Digital in 1983, for those of you who remember computer archaeology. My PhD is in computer science, in machine learning and AI. I've been involved with AI since about '82. And today, in addition to startup boards, I'm on the advisory board of Caltech, on the advisory board of a Department of Transportation center in New York, and a few other philanthropies.
And you've got a fantastic blog as well.
I do blog, and I also am about. Excuse me. I'm about to publish my 3rd book. I write a lot about AI and mobility. So, yeah.
All right, great, thank you. So in 30 seconds or less, we'd like to just go down the panel, and maybe Evangelos, we'll start with you since you've just ended off. Tell us a little bit about Synapse as your sweet spot, stage, sector, typical check size, and whether you like to lead or follow or syndicate your investments.
So we invest exclusively on early stage startups that develop enterprise software AI applications. So to us, that means it needs to be software only, focusing on the enterprise, with AI being a key ingredient. Now, it doesn't have to be machine learning. It may be other parts of AI, but it has to have that key ingredient in the solution. We want to be in the first institutional checks in. So we do seed and Series A. Typical early check size, again, it has gone up over the past few years, but it's somewhere around 300 to 500, and want to put, when all is said and done, maybe up to about $1 million, $1.5 million per portfolio company, and then hope for the best.
Excellent. Thank you. Ekta, tell us about you first.
Yeah, so with UFirst Capital, we invest across all stages, but largely in enterprise tech companies. We like to work with companies who have a product market fit and some customer traction, so they can really utilize the strength of our corporate network that we have harnessed over a period of 20 years in the Valley. And that said, we do a seed stage and our seed stage and early stage investments as well, and we've done a couple in the enterprise tech space.
And what are the typical check sizes when you invest?
So we would invest between 3 to 5 million, and I think we can lead or follow, actually.
Great, thank you. Sabrina, tell us about Omni.
We are a pre-seed and seed deep tech firm. We really enjoy investing into manufacturing and industrials. Our check sizes range, we start around 100K, but we definitely do follow-on investments of 1 to 3. We were just talking about earlier on the panel that the pre-seed and seed terminology has changed in terms of the valuation ranges recently, but our seed max is around 13 million. So anything that or below is something that we'd be interested in. So really first check.
Any focus in deep tech? Are you in space? Or are you in climate?
Yeah, we like manufacturing and industrials. What that means to us is anything that helps ship a product out the door, either ideation from designing CAD tools through manufacturing automation, think robotics, all of the standard AI applications in robotics as well, all the way through supply chain. And then tangentially, a lot of our companies as well have some kind of clean tech play in some regard, but we don't qualify ourselves as a clean tech firm.
Great, thank you. So Schwark, tell us about Trinity.
So we do early stage. Again, like everybody discussed, the tags are kind of all bastardized at this point. So early up to an A, sometimes even a B. So it's kind of seed through B is probably how you should think about us. But the bulk of our deals we do at the seed to A. That's kind of like the sweet spot, depending on what you can call a seed or an A here. We tend to lead the rounds we're in, and our check sizes, depending on where we come in, can go anywhere from $1 million to, I don't know, $12 million. It's usually, most of our checks are between 1 and 5.
And when you do $1 million investment, are you still doing heavy diligence and board seats, or is it sort of much lighter? It's just sort of placing a bet on the founding team.
No, I think the way to think about it is we want to buy our ownership when we come in. So we're not trying to make these early marker bets that then we'll see if we want to buy more later. So we will do the diligence up front. We do want to have conviction on the deals we do, which is why we lead them. And on the board seat stuff, it varies, and especially when it's very early, sometimes it doesn't make sense to have much more formal board. But in general, we probably will have some say in governance in some way.
Great, thank you. Karen, tell us about Entrada.
Yeah, so Entrada is a seed stage, and it's a seed stage fund. We invest, and I guess average is between $1 million and $2 million, but we've gone lower and we've gone a little bit higher. I think we focus on enterprise and industrial technology and kind of follow the expertise and interest of our founders, which range from technical founders all the way, to more software-oriented. So our key themes right now include things like next-gen computing, which would be AI, all the way from the software to chips. It would be we have some quantum computing software. Next gen, we have materials and material platforms, vertical SaaS, and kind of bits to atoms or digital to physical. So that includes some electrification and some climate plays, but we also are not specifically a climate fund.
And do you typically lead the deals?
We typically lead the deals or co-lead and syndicate. Like we try to partner with other folks as well. And then we like to take a board seat because we feel really strongly about partnering with the founders and really providing stage appropriate support and kind of making sure we can together build the right foundation, again, stage appropriate, to make sure that that next round of funding can be as secure as possible.
Excellent, great, thank you. I think hopefully everybody's got a really good idea as to the background of the panelists and also their funds, focus sector and check size. So let's talk a little bit about the venture landscape. I'll open this up to the panel. How would you describe the landscape in 23 and how has it evolved over the last few years? Evangelos.
All right. So maybe a little bit of sanity is returning. The last 10 years have been, I was saying to, before we started tonight, I was saying to some of the other fellow panelists that in all these years that I've been a VC, I've never seen such a long, uninterrupted period of growth. Which creates some interesting problems. It creates, sometimes slowing down is good and catching your breath and recalibrating companies, and we haven't had that in a while. So the current environment, first, if you take out generative AI, is one where some sobriety is returning. And we are, even in our own portfolio, that is only AI companies, we're seeing some companies, even though they're meeting their targets, having trouble raising new capital. There is no, a lot of investors have a lot of dry powder and sitting on the sidelines, and we don't see a lot of exits. We don't, maybe on the very low end, we see some charity acquisitions, as I call them, but we don't see a very the type of environment that we saw, that we had up to probably April 22. That's when we started to see a slowdown, which has accelerated as opposed to just becoming a blip. I'll end by saying that it is good that we do not, that the economy appears to be quite healthy and stable. I think we would have had much more dramatic environment if we were not where we are today. But particularly, I would say not only early stage, but I would say early to BC rounds, there's a noticeable slowdown right.
How about you, Schwark? How would you describe the 23 landscape? And from your perspective, you've obviously been doing it a while. How have you seen it evolve? How would you describe it?
So I would say we've gone from insane to frozen. So
in a very short period.
Very short period, right? I think to Evangelos' point, what has happened is valuations have gotten saner. But I can't see very many people making any investments at all, right? So we've gone from investing in anything that moves to basically not investing at all, with the very marked exception of generative AI, when anything that moves still gets money now, right? So
although that may be changing, right? Investors may be becoming more discerning,
I don't know about that. I haven't seen it yet. So,
Give them the names.
so I'd say that generally speaking, there is a pocket of insanity that still lives, but for the most part, there's not a lot of activity happening. I think to Evangelos' point, there's companies that are doing really well in a pre-bubble standpoint. And when I talk about bubble, I'm talking about the last 10 years. So if you look at before the last 10 years, a company that was performing like it's performing right now would actually be a very good investment. And actually, I think is a good investment. But it's harder to find takers in this market for companies that are even doing well. So if you're not doing well, forget all about getting funded.
Ekta, do you think 23 is the year that we find the bottom?
2023 is clearly not showing great signs for the angel and seed funding scenario. And I didn't just want to bring in my opinion, so I brought in some data actually that actually resonates with what you just said. And the data says that the angel and seed activity actually declined to 34%. Of all the deals that were made in Q1 of 2023, whereas usually it hovers around 47%. So there is clearly that inactivity, that winter, the frozenness is felt, and it's more so felt in the angel and seed stage of the companies. And if you combine it with other data, which kind of says that instead of a much higher percentage earlier, only 62.8% funds are now, in Q1 actually, 62.8% of all the funds raised went to funds that were 500 million and above funds, which means that money is flowing in to the larger legacy rainmakers as opposed to relatively new fund managers who look for new and innovative deals and are really feeding the seed stage of this ecosystem. So combine the two, it makes a lot of sense to say that, yes, this particular stage is going to see some harshness even in the future. And coupled with the fact that the IPO scene has not normalized as yet, there is lack of liquidity both on the VC side and the LP side, who's feeding the VCs, which kind of creates a tightness on the later stage of the company, making it sort of a reasonable opportunity for growth stage companies to raise money based on their performance, but not the later end or the earlier stage of the growth cycles.
What do you think, Karen?
Well, I have my two reactions, and the first is a friend of mine was saying that's why you're seeing a lot of market maps on LinkedIn. People have a lot of time on their hands that they're not doing deals, they're analyzing, they're looking, they're waiting. So I thought that was kind of interesting. And I think, the goalpost has moved. I think we can all acknowledge that the goalpost has moved. And over the past many years, you had venture companies, venture funds, and venture-backed companies subsidizing us. So thank you, Lyft, thank you, Uber, thank you, DoorDash. Even though it was super expensive, it still was actually subsidized. And if you really looked at it, the unit economics didn't work. And they're like, we'll make it up in volume. Now we're here, and they're trying to make it up in volume and turn a profit because there's no more cash for those subsidies. And I think companies going forward are really going to have to take a look at their metrics, really take a look at the economics, and understand how to build healthy growth going forward. And it doesn't mean it can't be as quick as we would like, but some of it may take a while, some of it may happen more quickly, but really looking at how to build healthy, sustainable businesses.
So are you focusing more on the KPIs now than you were, or was that always a focus and this continues to be?
That was always a focus for us. I think it's kind of hard when you're looking around, and I think passing on things that seem amazing, you look at the valuations and like that doesn't, the math doesn't work. The math only works if there's someone again, if there's someone continuing to subsidize it later on, and what is it going to look like in terms of eventual exit? Can you get out? But we've always wanted to partner with entrepreneurs where we can work to build healthy, sustainable, impactful companies, disruptive companies that are there for the long term.
So Sabrina, maybe you could start off with the next question. Let's talk about the sectors in 23 that have been hot, and I'm sure you're going to mention Gen AI, and those that you're anticipating are going to be hot going forward. So you're in sort of the industrial, supply chain, manufacturing, but what are you seeing as sort of the hot areas of 23 and going forward?
It's a great question. I think the name of the game in this current market is picking which industry is going to be most disproportionately affected by AI. And AI is basically pattern matching with giant swaths of data. And so to pick a winner in that space, I think you have to look at which industries have large untapped amounts of data that haven't previously been able to be developed and drawn conclusions from in the past. That's why our fund is investing in industrials and manufacturing, because that's an example of a very established industry. It's antiquated, has not been really had a software facelift in decades. And the name of the game in industrials and manufacturing is that you have lots of data that you need to parse and process to make your products as impactful as they can be. And so I think it's not like everyone knows that like AI in general is like the thing, but we're trying to figure out how to strategically pick the right application for that thing in the next 5 to 10 years. And that's the strategy that we're taking ourselves. Outside of that, I think there's also a huge increase in like the med tech boom recently, particularly because it's another industry in which there's infinite amounts of data that people are trying to collect and process and parse. So it's one that we're keeping an eye out for, probably for Fund 2, Fund 3, but not for right now.
How about you, Schwark? What are you seeing as sort of the hot areas now and into the near future?
So look, the question to interpret it appropriately, if you ask me what VCs are investing in, what they think is hot, is Gen AI. That's the only thing that's getting any money right now, right? But I also think that area, just given the amount of craziness going into it, to create investment returns is going to be more difficult, I think, because everything's getting priced like crazy. It's unclear how many of these things are actually even going to survive. There's just a lot of noise. So I think it's going to be triply difficult to actually find good companies to create investment returns for most venture firms. If you look at what I think the hot areas are going forward, I'm excited about a couple of different areas. One is developer infrastructure. I think the way that engineers are writing software is changing and going to change substantially more over the next 5-6 years. I think that entire thing maybe makes a lot of software opportunities in terms of serving them and helping them both write software, deploy software, manage production systems, the whole works, right? So I think that whole area is changing a lot, and I think the infrastructure to support them is a big opportunity. There will be some AI in that too, because there's a lot of engineers that are actually building AI models. So I think the infrastructure to build AI infrastructure is also kind of small. We have a couple of investments already in that infrastructure for AI space, but I think that's going to be. But in the AI world, I'd say the infrastructure for AI is probably one of the best places to be. It's kind of like the Levi's of the gold rush, if you may, right? So it's perfect. Yeah. But then the second area that I think is interesting is I have this big thesis around post-bubble monetization. So if you look at the first bubble of the internet in the 2000s, there was a lot of interesting, stuff that happened. Mostly a lot of money was created and lost very, very quickly. But all of what you know as internet companies today came after that bubble, right? So everything is online now. Your bank is online, your retailers are online. All of that stuff happened after the bubble. The bubble was the innovation, and the post-innovation cycle where the innovation got embedded into the rest of the economy is kind of where all the big value got created. We just finished a big bubble, a fintech bubble. Like everything fintech was really, really hot. A lot of money was again created and lost very quickly. But I think there's a lot of key innovations that came out of that cycle that I think will get embedded into the rest of the economy, which I think will create a lot of value over the next 5-10 years. So that's another big area that I'm.
Can you think of anything in particular that sort of is going to come out of that fintech bubble that's going to change or disrupt, the way we do things?
So I think the biggest thing is going to be what I'll broadly call the embedding of fintech. So like today, when you think about it, you go to your bank to basically, get a deposit. You go to, a credit card company to get a credit card and so on and so forth. And soon, I think you don't have to kind of pick and choose a financial services provider where you centralize all your financial services activities. Those will get distributed along with other relationships you might have, right? So like, Apple's doing financial services today, right? That's a kind of embedded fintech, so to speak. But even today, they are still putting out a credit card or they are creating financial instruments. But over time, the financial instrument will be embedded. So when you're having a deposit account, you might not actually go out and open a deposit account. You might just have a relationship where you start accumulating value and accumulating, interest-bearing returns off of that value without ever having to technically open an account, if you may, right? Same thing with credit. Like you actually get access to credit to do certain things without actually ever applying for credit per se, right? And so the embedding of fintech into other businesses.
I guess it's kind of like, Musk is trying to at least put across, what X is going to become, an entire platform, fintech platform, sort of what it wants.
I don't think X was going to work, at least the way he thinks about it. But it did work in China. But it's kind of not worked almost anywhere else but China, right? So it's kind of like one of those things where everybody looks at China and says, "Oh, we should have our own WeChat," but there's not been another WeChat anywhere else in the world, right? So I do think, yes, in China that kind of vision kind of played out. One of the specific areas where I've been very focused in on is what we call SMB SaaS. So where you embed fintech. SMBs are incapable of spending a lot of money to buy software, but they have to modernize because the consumer expectations have changed. So they actually have to kind of create infrastructure to serve these new consumers. How do they buy the software? They can't spend a lot of money. Fintech actually enables the software developer to actually distribute software at low or no cost, but still monetize on the money flows going through the business, which is, I think, again, another way of embedded fintech. So this is where I kind of think like you can create real innovation, which is free software is the innovation, but it's powered by embedded fintech, if you know.
So on the flip side, are there sectors that you see are cooling or have cooled and are going to be really tough to get funded, going forward? Maybe Ekta?
Sure. I think there are some evergreen sectors that are not going anywhere. And with the tightening of regulation, there will be a lot of forced mandated interest in those sectors. Cybersecurity is one. And then, to me, I look at Gen AI and or LLMs in particular as a tool and not a solution or a product. So just much like when the PC was invented, what was handed off to the consumers was not a product. It was a tool, to each one his own application for the tool. And so with the LLMs coming in, there will, of course, be verticalized solutions targeted towards those LLM. But there's a lot of lot of subsectors that are created within the generative AI space to support this big wave. For example, Stripe, even larger companies, not just startups, but Stripe has integrated their payment into ChatGPT. So to your point of embedded finance, this is the kind of tributaries ChatGPT has entered into, and the kind of channels Stripe is. I think that sort of a dating or a marriage will bring interesting user applications, interesting new applications that founders should leverage and think of in terms of how to kind of use those sub tools that are coming in to build applications that ease business for the small and medium businesses as well as larger companies. So long story short, there are new sectors evolving, which probably we do not have even a name for them. And it is it is like I said, it's like when the PC was handed over, there was to each one should be encouraged to think on what sort of technologies can come out of it, can be created. LLM is a tool. If you can think of payments, you can think of synthetic data. That's already a lot of startups who are creating synthetic data to train LLMs so that the data does not go outside the organizations, and the employees are not having to, they're not looking at it and saying, hey, I can't use ChatGPT because of these issues, privacy issues, but that doesn't mean that I'm going to left behind in terms of getting access to a tool that deals with multivariate problems.
Yeah.
So those are.
So do you think, Evangelos, you're a technical guy? Do you think Llama 2 is going to kind of spur this innovation now that people have access to these models and it's free?
Absolutely, I think. Sorry. No, I think I thought it was a continuation.
So the way we look at things is in terms of what are big changes that can be impacted, and we're coming out of I think two particularly big changes. One is what's happening post-pandemic, and post-pandemic, first of all, every enterprise, regardless of the industry, they are rethinking what it means to have an employee, what this employee does, how do I deliver my product. So there are a lot of processes that are being reconsidered. Now, if you add to that what AI is making corporations aware of, they are starting to rethink their processes yet again in terms of how can whether it is generative AI, whether it is discriminative AI, some of them, unfortunately, they're just now becoming aware that there is such a thing as AI. How can this change how can I rethink my processes? How can I change my processes? How can I automate which part of process? So I think software programming in general, software engineering, product development is an excellent example. We just did some work for one of our corporate partners, as we call them. We went in with the CFO thinking, I'm going to let so many of my software engineers go because of I'm hearing about generative AI, they can program, blah, blah, blah. And in the process, they determined, no, they just need to change how they develop software and who does what. And they may have some savings, but they're not going to come because you're going to, in a wholesale manner, let employees go. So, long way of saying that it will be good for, at least for startups that are thinking about enterprise software applications, to try to understand, to stay, to keep their eye to the ground and try to understand how corporations or entire industries are changing their processes, both because of the environment that is emerging post-pandemic, but also because of other technological forces that are impacting those changes.
Karen, so what are you seeing? What do you see as sort of a cooling trend or sectors that potentially going to have a hard time for funding?
Yeah, I would say that I do think that right now AI is very hot, but like any other sort of analytics that's come before it, it will or has the potential to get commoditized very quickly. And again, right now it's being subsidized very much. And once the price is actually right-sized, creating that value, I think, is going to be very important. We tend to, especially in Silicon Valley, kind of pat ourselves in the back about the technology that we create. But we forget that what we're selling is the benefit and the value to the ultimate buyer, whether that's a consumer or enterprise or industry or whatever. And so I'm looking right now for, it's kind of funny, I wrote down, my name is boring, because what I want boring, like something that's going to help a user, a customer, a company, a client, that's never going to go out of style. It's going to be completely visceral to them, and telling them what it has in it is usually not as helpful as telling them what it does for them. And the money it saves them, the time it saves them, the revenue it gets them. And so and what problem it solves. So I'm actually happy for things that aren't getting noticed right now. I mean, this is my sneak peek out for the internet, but like I think there was a lot of hype on space tech. I think there's still lots of really interesting areas of space that have yet to be explored, unintended. I think there's a huge opportunity. Everybody has been focused on climate and energy in particular, and water is going to be our next big crisis, and there are lots of opportunities there. It's a space that I've spent time in, and I think there's some really interesting opportunities there. I think we're all talking about how to manage the data, and part of that is thinking about who knows what and when. And I wouldn't say it's necessarily a security play to your point, but zero knowledge and understanding who gets what and when and how you can still transact is going to be really interesting and maybe part of that fintech. Whether that's a feature, whether that's a company, I'm looking to have that problem solved in a number of these different fields. And again, just productivity in any shape or form that's going to be insightful and
Excellent, thank you. Schwark, maybe you could take the next question. We'll switch gears a little bit and open this up to the panel as well. Can you share your ideas in terms of your approach to identifying and evaluating potential investment opportunities, and what are the key factors that you consider before you actually make an investment?
So I'd say that the calculus varies slightly based on which stage we're coming in at. If you come in at the seed level, I think the bet is primarily on the team. There is some evidence of product and so on and so forth, but the way I like to think about it is by investing at the seed level, the one thing we probably know is that they're not going to be doing what they're doing now when they go IPO, if they ever do, right? So what we're really kind of betting on is this team going to be able to navigate between whatever they're doing right now to what it'll take to go public, right? And there's multiple elements to that. One is, can they do it? Do they have some kind of a what I'll call an unfair advantage or an unfair insight in trying to get after that particular space? And then lastly, do they have the hunger or the drive to actually take it that far? Because it takes a lot of determination to actually go the distance. It's not a straight line. It's going to take a lot of ups and downs. You have to have the stomach for it, and you have to have the hunger to basically say, Zuckerberg famously said no to $1 billion something from Yahoo, and he said, I don't want to take it because he wanted to build something bigger. It's very rare you'll find someone that says no to $1 billion, right? So I think the important question is, do you have people that actually want to take it that far? That's kind of like the calculus for earlier stage. As you go farther along, it starts to, that still is always important, but it becomes coupled with the performance of the business, the metrics you learn from what they've already done. So there's more history, so you can actually see what they've actually done, both with the projections versus performance, as well as the actual absolute metrics of the business.
So at that early stage, are you expecting to see any unit economics, or just some sort of validation, some sort of market fit, not necessarily unit economics at that seed stage?
Yeah, I don't think you can get unit economics at a seed stage, or whatever you get is irrelevant, because you're doing it on 10 people. And so the unit economics there are completely irrelevant. I think what you are looking for is that there is, in fact, some market need that's being met and being done in some way that's markedly different than what's already available, right? And so if we can see that signs of brilliance or greatness, then that's something to lean into.
Yeah, I was going to add, I think I agree with all of that's been said, and I would add, I think you don't have to see unit economics, but how are they thinking about the business? And I mean the business, not just the tech, as I said before. So it's really thinking about that team, how the team works together. And then I think in terms of, you were saying that sort of that personality, it's this weird balance that you're looking for of this stubborn conviction in what they're building, coupled with a self-awareness about where they might be wrong or what help they need and what questions they need to have answered. And that's really difficult and actually fairly rare. And we're always kind of looking for, and if they don't have it right away, do we see signs that they could have that and engage a little bit more along that path? And that's, I think, the mark of a really potentially successful entrepreneur in business.
Sabrina, how about you? What's your approach to identifying the right fit?
I completely agree with the founder persona that was described by both folks. One thing in addition to that, like understanding that the company that they come to pre-seed with is likely going to be a different company by the time they reach IPO, that you're looking for founders that are able to sort of hustle and pivot and have the self-awareness to understand how to do that well. A third thing that we do look for, though, is a data moat of some kind, and you did absolutely touch on this already, but we define data moat by, again, having an industry insight that is defensible in some capacity that would either take a competitor a certain amount of time to learn enough about the industry to recreate, or even something around like IP and patents. Our team ourselves have 80 patents among us, so like we understand IP very early and very well, but that alone is not necessarily defensible. Like there has to be something in addition to like the use of the idea that is novel and would take competitors some time to solve. And I think this is specifically a very unique space in the deep tech world as well. For other types of industries, like certainly for a consumer, it's all vibes and all like finding people that like certain things. So it's very different in that realm. But for deep tech specifically, understanding data moat well is a very key differentiator. And if you get that, it's a really good indicator there'll be a good team.
Evangelos, maybe we could just flip it around and just, are there any red flags that make you really hesitant to invest or make you want to run?
In good times, when the investor actually has time to do proper diligence and all of that, we're looking a lot at how the team interacts when they come to see us. We like to see obviously a certain diversity in the skill set of the team. And diversity that is relevant to the problem that they're trying to solve. And we want that the knowledge, the value that each team member brings to this nascent business to be showcased. So how they respond to questions, whether there is a monologue from one of the founders or whether there is a participation from the entire team in addressing whatever questions we ask or whatever issues come up during the diligence process, to us these are indications of how things could work out in the future. The other thing that I can speak now also as a founder of companies, it's important to understand. On the one hand, you want to see that willingness to chew through walls, to go through walls. But you also want, which implies, some cockiness, some stubbornness, all of this. But you also want to see the willingness of, particularly of the founding team, to be replaced from the leadership positions they have now. I mean, a founder is always something special for every startup, but doesn't mean that that special bond, that special role always has to be played in the CEO position or in the CPO position or whatever they need, CTO position, whatever the initial allocation of responsibilities is. And this is, I was thinking that one of the reasons that the venture profession is not, or the venture industry, if you want to call it that, is not scalable, is because understanding these nuances in a team is not something that you can write a book about, or you can write a blog about, or you can go take a course about it. I mean, a lot of people have tried, but I can tell you with a 30-plus year experience, both on the entrepreneur side and on the venture side, that it is not scalable. And that's why we have what we have today in the venture world.
Just switching gears, because I know we're almost out of time. I see the bouncer coming towards me. what is some of the, Ekta, maybe this one is for you. What are some of the common misconceptions that founders may have about venture capital?
That's an interesting question, I think, and actually changes with times. A lot of the times the founders come with a great idea, and if they hear a no, they get very disappointed because they either feel that the other side of the table doesn't really understand the market well enough. Now, which can be true, by the way, as well. So founders need to do their diligence on the person they're speaking to on the other side of the table as well. But they have to come with the mindset that there are 20 other reasons of why you hear a no on the other side, and it doesn't have to be anything to do with the idea that you're proposing to the venture capitalist. So I think the founders need to be aware of that. Those reasons, should have heard about those reasons, and they should poke into what is the actual reason out of those 20 to be able to really understand why they heard a no, to avoid the same mistake a second time they see a venture capitalist.
Go ahead. No, go ahead.
I was just
Rob
gonna
said we got extra time.
I was going to say, one of the things that I would encourage everybody that's trying to pitch a VC to understand is actually what makes the VC tick. I've been on both sides of the table. I was an entrepreneur, then I became VC. And I wish I knew as an entrepreneur what I know now, which is when you run a VC fund, we're here to return 3x on the fund. And that basically depends on what the size of the fund is, what they need to return, and most of those returns are going to come from 2 or 3 winners. They're not going to come from the entire portfolio. And so you have to know that every one of the bets that we make has the potential to basically help us return the fund, right, at the levels that we want to. And which basically means that the outcomes need to be of a certain size. Now that varies based on the size of the fund. If I'm running a $25 million fund, I have very different benchmarks than if I'm running a $400 million fund. And so talking to who you want to talk to, knowing what they need to see if your business actually has the potential to have the kind of outcome that'll make this thing tick. But it also depends if you're running a $2 billion fund, right? And there's those two nowadays. So
I find also, and I try and coach my entrepreneurs to switch hats and think like an investor, because I think founders get so enamored with their own startups that they kind of forget what makes them unique, a different, a more attractive investment in terms of risk mitigation, in terms of traction or whatever. Final question, Rob. Promise you. Emma, we could just run down. We'll start with you, Evangelos. What are the 3 most important questions that you think an entrepreneur should ask a VC before taking their money?
They should definitely try to understand how they deal with when situations are not going as planned, or when the company is not evolving as they should, when they're not meeting their goals.
Is that a question for the VC or for the portfolio company of the VC?
No, I'm saying that the founder should be asking that of the VC. Okay. They should try to understand what the VC is investing in. I mean, you will be surprised at how many people come, either talk to me directly or come to our firm, and they really do not even try to understand how we invest and what we invest in. And it's right there on our website. I mean, it's not that some hidden secret, okay?
But I'm thinking more like you've got the term sheet, you're about to do a deal, you're going to get married for a long time. What are sort of the 3 most important questions before you take the VC's money? Yeah, we'll just open it up. Karen?
I think the first we were talking about before, so I feel like I cheated a little bit, but we were talking about the state of venture now, and there are a lot of funds that either raised and that are already at capacity and are with the data that you presented are not necessarily in a position to raise another fund. So the first question is, do you have dry powder? Do you actually have follow-on funds and the ability to support me? Will you be around for your next fund? You kind of want to get a sense of efficacy there and stability because you're betting your business on that. The second is, are we aligned on the plan? And a lot of folks will look at the deck and will say, yes, they'll write a term sheet. Things are moving very quickly. We always like to see an operating plan. And the one thing that we know from that operating plan is that it's going to change. As we've all said, it's not going to be the same plan. But what we're looking for is, are we aligned on how we're thinking about this next stage of the business and growth? Are we, and if we don't agree, do we have a healthy debate and disagreement, and are we testing quickly to understand? Because the last thing you want is to get into that first meeting after the term sheet and have a surprise on either side. So really looking at that plan with the understanding, like, here's what I know, here's what I don't, here's what I'm going to test. Does this make sense? And that, you know, and making sure that works. And then the third is references. You always get customer references, vendor references. Ask that fund for references of founders in their portfolio, and ask those founders, how has it been? How helpful have they been? How has your experience been? What should I be looking out for? How's it gone when things are good? How's it gone when things are bad? Just to get a sense of what you're buying, because you are buying, you're buying their money and their help for a long time, hopefully a really long time, to make you successful.
Anything, Schwark, that you, from your prior companies, that you kind of wish you'd asked the VCs before you took the money?
Well, I'd say that the one important thing that's worth asking is why you're investing in me. I think the motivation of why that VC is interested in the company in the first place is going to be, I think, a good indicator as how your life with them is going to be over the next, 5-10 years. There's a lot of VCs that love traction, so they're investing in traction. There are a lot of VCs that like the competitive deal, so they're investing because they want to win the deal against 6 other venture firms. There are others that basically just have conviction on that particular space. They've been looking for a company that want to invest in that space, and they've then picked you as the winning team to make their bet. I think each of those kinds of things will have different kind of outcomes. So I think understanding the motivations of the VC for why they like this particular deal is important. I do think asking them about the down cycles, like both how they say they will behave with difficulties, but also how many of them have they been in so far? Like, how many times have you been in a situation where the company cratered and needed more help, or you've had to change the CEO, or like try to understand what I'll call the divorce scenarios, right? So you want to understand all the different cases that could cause a divorce in like a marriage, for example, and try to understand like how do you react and what do you need to do.
So glimpses of that on the Thursday evening before the Friday of Silicon Valley Bank. It was a really good indicator as to VCs and the way different VCs were looking at that. Sabrina, we'll finish with you,
I can speak specifically to if you're raising a pre-seed or seed round. I think it's critical to understand how VCs work with their founders. So question number one is like, what exactly is our structure moving from here? Like once I sign this agreement, are we going to be having weekly meetings? Like what are you going to be introducing me to? What value are you providing to me outside of just this check? Who is in your network that you're going to introduce me to? What advisors can you bring to my company and to my table? It is the investor is so much more than just money at the very start of the pre-seed and seed companies. They're adding additional value. And make sure you pick a partner in that early stage that can really bring you through to the A, because that is the entire goal.
Excellent. Oh, Ekta.
I just want to very quickly add a real life story here. There's a founder who came to us and said that he had raised significant capital from one of the top 3 Sand Hill Road funds. And he said, you have helped me more before investing in my company than one of these 3 top VCs has. And I was thinking here, sitting back and thinking, we need to work harder to win you. So, it's kind of like a dating situation. Depending on where you stand, you have to work harder towards. And then it's also the mindset, how the investor is kind of wired to look at the idea that you're presenting to the person. If the person is wired to look for connections, and then it automatically starts happening in your brain, and it's not like you're trying to favor an entrepreneur by giving all these opportunities to connect, but it's just natural, yeah.
Excellent. Thank you so much to the panel. Appreciate it.
All right, panel, you definitely exceeded expectations.
And time.
You exceeded the time limit, but thanks to the moderator. But we'll try and get back on track. So if you have a question for the panel, walk up to the mic stand, ask away. Don't be shy. This is not a pitch event, so do not deliver a pitch or a thinly disguised pitch. If you do, you'll have to deal with Joe, our bouncer. Enough said. Ask away.
Okay, this is a question for the whole panel. I have actually run into a lot of VCs, and it's a big thing where, it's kind of like the dating situation. I notice a lot of them don't even get to know each other. Like, how do we kind of solidify that bond and build a great friendship before everything takes off? Like, I notice we don't even get to know each other as friends before we even start to do business. How do we kind of massage that little introduction into something way greater than?
By the way, I always try to go out for dinner with my founders before we put a term sheet out, because part of me is actually trying to understand who they are as people. I want to know what motivates them. Why are they founders? What do they want to do with this company? I want to understand them and what their motivations are. And ideally, they should be asking me the same kind of questions over that dinner. So yeah, I do think you should take that time. What I did as a founder, by the way, with one of my investors that I did not know, is I actually asked as part of the investment that we have dinner every month till we get to know each other better for the first year outside of the board meetings. Right? And that actually helped me kind of understand my board member a lot better.
Wow, thank you.
Great. Next. Ramon.
Doesn't fit in there? Hi there, my name is Ramon. I have a question. This is in regard to companies that have a hardware aspect of their companies. And obviously it can be hard to get a hardware company funded, but if you think about it in terms of AI, it's only as powerful as the data that you get. And you may, if you think about in this room, unless you had temperature sensors in a hardware company making the temperature sensors, well, you can never create value from the data, the continuous data generated from those sensors. So that's a long setup, but my question is, imagine you have a company that has a hardware component, but in service of effectively creating data that doesn't exist so that you can generate value from that. How would you pitch that to investors to kind of clear that first pass hurdle of, oh, I heard the hardware word, I'm checking out of the conversation? How do you get past that? Pardon?
Sorry, for everything. I mean, here's an example that I've, several years ago when autonomous vehicles started coming to the fore, is nobody knew of LiDAR. And they had to create a use case. The companies that were developing LiDARs, they had to create a use case. Say, here's how you're going to use the LiDAR in the autonomous vehicle. And then investors got it, and obviously because the users or the developers of autonomous vehicles got it, right? And they saw how the value chain is created, right? So somehow with your hardware solution, you need to show where you fit in that value chain, right? In what value chain you fit and how you fit in that value chain. And then it should, for the right investor, it should become obvious. But there are many cases, and I said, I can only think of LiDAR, but that doesn't mean anything.
Right. So, I mean, essentially it's still pitching, why is the customer going to love it? What's the value to the end customer? So, okay.
What's the value to the end customer, and how are you going to capture enough of that value? So I think depending on what the economics look like of it and what the ecosystem, the value chain, like he said, looks like, are you going to be commoditized with a low margin and then it's very valuable, but you're not able to capture it? So understanding where you sit and why you're going to be able to capture the value, and I think also how long it's going to take to penetrate that market.
Right.
A lot of these markets, when you're selling hardware in, they can be very long sales cycles. It's hard to get feedback. The customers take a long time to make decisions. So thinking through what your first vertical is and that first killer use case where you can prove that out as quickly as possible and test those theories are going to be really critical.
Great. Thank you.
I have a pictorial view to it, actually. Think of it as a wood. If you put a piece of wood on the table, then you're leaving it up to the investor to think what you'll do out of it. But if you create a pencil out of it, then you know exactly what you're trying to feed to the other side of the table. And then I think you have to prove to the other side that you have the right or the best team to convert that wood into the pencil.
Thank you.
Hi, my name is Shardul, and I have a question. So, in this era of emerging technologies like quantum computing, and we have got Gen AI and blockchain. So, what are your indicators in which you assess the long-term potential of a startup?
The jockey, actually, I would say, and whether they have really taken the time to understand the product market fit, which is simpler said, but takes years of experience to be able and network to be able to do that, because it takes a lot of listening to understand where the real lacunas lie in the corporate world and see if the product that you're proposing will be able to fit into those lacunas or will be able to bring in something more innovative than is being considered within the umbrella today.
And to touch on that, those three things you mentioned are all tools. They are not products or like end goals themselves. And so I think the application through which those things will be used and the viability of that is really what we look for as well. Not just the use case of blockchain in general,
I see. So basically you assess the application and its long-term viability.
It's identifying a use case for those three different technologies that you mentioned, and actually understanding market sizes and TAMs that are large enough to support the idea, using those as tools.
So has there ever been a case with you where all the indicators were perfect and you just, had to trust that this enterprise is gonna, it's gonna be successful, but then it just was a big failure? So has there been an example for you like that?
Of a portfolio company failing, or of like a bet?
Everything was perfect. All the indicators were perfect, but regardless of that, it was a failure.
All the indications are never perfect. You're never investing. I mean, you're understanding what the risks are and the opportunities when you make an investment all the time, and what's in your control and what's not in your control. And that's the best that anybody can do, is make the decision with the information, the best decision with the information that's given to you at the time. And so you're looking at kind of all the elements that we talked about. You're looking at the team, you're looking at the market opportunity, you're looking at the value that's being created and to whom and in what ecosystem. All of that adds up. And then even with all of that, there's, the most promising, there's so many things that can happen along the way that on both sides, incredible luck and incredible bad luck that can result in an amazing winner or just didn't get there. And sometimes, again, it's not a reflection on anything. It's just bad circumstances, or it's amazing circumstances that folks were able to capitalize on. And you want to have people around you that have enough of the characteristics and experience to be able to capitalize on those opportunities when they present themselves.
All right. Awesome. Thank you.
Great.
Hello, team. This is Hakai, and I'm currently building up automation for the system design tool. So my question is so there's no secret that I'm using GPT-4 plus a long chain, which is okay. Not patient. I'm just giving more context. So I'm using long chain GPT-4, which is embedded data So my question is like, I know there's tons of teams that are using the same tech stack. So what are the VC looking to the differentiator other than the same stack? Like, is that execution or like business model? And probably another aspect of this question is like, what should we focus on to make the differentiator for the same tech stack? Yeah.
Data moat is the thing that we look for. So the data that you're using to actually train your model on, if that is substantially larger, substantially more specific for the specific application that you're targeting, then, and that proves that you'll beat the competition, that's something that we'd be interested in, certainly. So it's basically the data model that you're training your system on. Not just leveraging the LLM. So, for example, if we have a portfolio company that is developing a tool for early stage engineers to design engineering products at the very earliest stages, help them, actually they call GPT-4 to iterate on their equations and basically create code and generate code to solve like very generic English language queries that are sent into the model. How are they doing that well, and how are they actually improving ChatGPT-4 on top of that? They have partnerships with people at Google, at a handful of really high-quality companies across, and they're actually getting those teams to input their own data to understand how the model will improve over time. So they have specific access to teams that are putting in very specific data that's helping it grow better.
Yeah, that makes sense. And also, I know there's a trend that actually the industry is like more open source for data. For example, there's a new data set which is for the maps, which is currently open from like Meta and other joint companies. So does that mean the end game would be like everyone would get the same tech stack and the same data to build up, but like it would be the winner is who is the first one building up some like app? Is that like very similar to the mobile first world that like Uber is the first one who building like this driving like sharing experience, so it is a winner. But the second one won't win. Is that the end game like for the AI world? I'm just wondering. Yeah.
Go ahead, Karen, Schwark, Evangelos.
I guess the first thing that comes to mind to answer your question is an analogy, in that it used to be that everybody actually back in the day had to build their own email servers in order to actually send and receive emails. And then over time, there were widgets and companies and applications and other things built that enabled that to be easier. And then now everybody just uses a third party and doesn't need to build theirs. Cloud is a similar example versus servers. So I think there's a little bit of commoditization that happens. I think the automatic competitive response to a closed system is an open system. So, and that just that's just a cycle that keeps repeating. So as we look to the evolution of these models, you saw sort of the Google memo, which is like, open's gonna win. There's nothing here eventually. Yeah. Well, how do we compete? Then that's the question. That can be some proprietary data. It can be a better business model. It can be some other unique industry insight in terms of how things work. It can be incredible sales execution, which people tend to discount. But when you've got a channel that just works and you can run that table, your tech can be okay until it gets better and good enough to have people buy it versus the best tech that might be out there. So those are some things to think about.
Yeah,
Schwark, you had some thoughts. This is going to be good.
Well, what I'll say is, look, I think Silicon Valley is obsessed with tech, and I think you think, okay, I'm going to build some tech. So there's two ways to win. Either you build tech that is really, really good, and that's what Larry and Sergey did. I mean, they were the 10th search engine. They were not the first, right? But their tech was 100x better than the next best thing that was out there. And so their tech won, right? So their tech was the greatest, and therefore they won. There's hundreds of other companies, including LifeLock, which is a company I worked at, that had very little tech advantage. That was not what they won on. but they did bring something to the market that was uniquely theirs. And that'll have to come from you, the founder, right? So you need to figure out what is it that you're going to bring that'll help you win, right? If it's your tech, great. If it's not your tech, you need to kind of come up with what it is that is going to help you win, because it's going to be something that uniquely you can out-execute everybody else on.
Sounds good. Yeah, thanks for that.
Great, thank you.
Hey guys, I'm Mahesh from Hatsashi. So my question is, I have been always told, I'm a first-time startup, I'm doing my first-time startups there. I have been always told that select your investors like your team. So is it actually true in the investor's mindset, or do they think they are above the entrepreneurs?
Strongly believe that for pre-seed and seed, they are absolutely an extension of your team, and you should treat them as such, and they should treat you as such. And if they don't, that's a red flag.
Okay, thank you.
Hi, Satish. First of all, thank you for a lovely insight, and it was quite beneficial for a lot of founders like us. My question was asked by my previous associate, but I have a follow-up question on that. Especially with respect to generative AI, the cost of computation becomes a major chunk of your investment. Do you have any thoughts on that? Like, for example, a A100 GPU, 80 GB GPU, it will cost you somewhere around like $3 per hour. So that becomes a major investment, especially in Gen AI. Do you have any thoughts on that? I know you care about, but how much of that investment becomes a decision?
It's actually a matter of concern even for the top 3 generative AI companies. And I can say that because we are in the middle of putting a sizable investment in one of the top 3 generative AI companies. And one of their founder is also trying to ask the same question on who will be my hardware strategic partner. So infrastructure costs are real. And so I think founders who are trying to do something on Gen AI need to either build that cost that they're going to incur into their model, or find some creative way of leveraging existing infrastructure and then building their applications on it.
Yeah. No.
I was just going to say that the availability of the hardware is now almost a public issue. There are venture firms that are basically competing and winning deals to invest in companies because they have secured preferred access to the GPUs and therefore able to allocate it. I think all of that is actually warped. That is not what should be driving any investment decision, right? It's a artifact of the crazy world that we're in. And I also think, just like Ekta said, the top guys are competing for it. Microsoft and Amazon are competing for it. Everybody wants the hardware chips. And Jensen seems like he's basically playing God, right, at this point. Now, the issue is, if that is the case, how do you still win? In my take on it is that you as a tiny startup are never going to be able to play that game. You're never going to be able to win that hardware allocation game. The question is, can you actually do something more creative, which is create a more distributed way of getting all that compute figured out, right? I mean, SETI did this long time ago, right? In a very creative way. They created screensavers for everybody to go use and end up creating a tremendous amount of compute power to go do a bunch of stuff, right? So I think generally I believe open source AI models are actually going to slowly do better than all these centralized models because everybody's trying to do everything in one place. The open source guys, they don't have the resources, so they're basically kind of distributing it and actually solving the problem in 100 different pieces. I do think solutions like that are the ways to have the smaller guys win.
Gotcha. Evangelos, you had
Yeah, so I would say, I think the era of the trillion parameter LLMs has come and gone. So you better start thinking, what I can do with smaller models, yes. Whether it is open source or proprietary. But I'm willing to bet that in the next 12 months, and I will speak as a computer scientist, not as a VC. I'm willing to bet that in the next 12 months, more and more companies, corporations, will realize that the building something on top of something like GPT-4 or 5, whatever it's, is not going to buy them anything. Plus, all of the data provenance issues, security, copyrights, all of that, will put a huge break to all of that effort. So whoever is thinking here about building or capitalizing on SLMs or whatever, because they're not going to be LLMs anymore, you better start thinking about vertical. You better start thinking about how I can deal with smaller models. And for those type of models, you will not need 10,000 GPUs.
Yes.
Okay.
Yes. Thank you so much. One follow-up question. Oh, sorry.
Hello, my name is Lina. I'm wondering, with all this AI, chat GPT and everything, do you mind if team consists only from key people and everything else it's outsourcing, like marketing, engineering agency, all agencies, and team is only key people, few key.
Can you outsource innovation?
Everything what you can outsource to agency rather than employ person and have deal with this person.
I think it is preferred actually if you are really thinking innovatively and you're not bearing the cost of everything that you can outsource and focusing with a laser on actually what your innovation is. And if the innovation itself is compelling and you are outsourcing everything that can be outsourced, it's a smart thing to do, particularly at the earlier stages.
Big relief, thank you.
I have a hot take. I guess I disagree with that. Specifically for deep tech, I think that understanding how to manage external teams is critical to making that work. And if you don't understand your own tech, then you can't do that effectively. And so I think it really depends on your vertical. If you're doing something that is deeply technical, probably not a good idea to outsource the engineering. If you're doing something in a different industry, though, it may make sense.
Thank you.
Great, thanks.
Sure, I'm told we have 30 seconds, so real quick. You're all VCs, you're trying to multiply capital, but I also know you've advised governments, universities, and so on. So I wonder, are you ever driven by other factors? Curiosity, can we actually get this done? Some kind of ethical values, can we not have the world burn, etc.?
Yes, of course. No, I think, again, our first responsibility is to our limited partners. And those actually, we all think about sometimes a bunch of high net worth individuals or family offices. There are pensions there. These are they put their retirement funds with us. There's a great degree of trust and responsibility that goes along with that. So I think that's something that we need to take seriously. We also, speaking for myself personally, I have places where I will not go and people I will not work with because I don't believe in either what they're doing or I like how they treat people. I don't want to be kind of involved in that. And so all the time we're making those assessments. And I think you have to think about what your philosophy is. And mine is that you can do plenty well by doing good. And that's the one I subscribe to. Others you see in the world, sometimes not so much, but I sleep well at night, so.
Excellent. Great, thank you. I think Joe is giving me the nod here. Yeah. I will certainly listen to him. Well, great, thank you very much. I think we have to turn it back over to Rob now, right?
Hey, Rob.
Or not. Okay. Excellent, we've got extra time.
You want to do any final comments?
Well, maybe I'll just let the panel sort of give the entrepreneurs a nugget of your wisdom from your background. You know, a lot of first-time entrepreneurs in the room. Just some ray of hope in this environment, or some tidbit of information to help them with their startup, or to get funded.
Thanks. So the obviously perseverance and good thinking are requirements, but not every good startup is funded by VCs. So when you think about how to finance your dream, really think about whether the venture route, for all the reasons that we explained here, is the right way to go. You can waste a lot of time and a lot of your precious time as you're trying to build your startup, trying to pitch to an asset class that may never be the right asset class for funding your work.
I'd say don't get too disappointed by the macro environment because that's going to evolve. But how well you're polishing your axe will really decide how sharp your cut is going to be whenever the environment is right. So really work very well in terms of understanding how you want to polish your axe and take the time to do it.
And I think you'll see, if you look back over the last few cycles, the most incredible companies that were born out of real, hard times, like Airbnb. Yeah. So this may be an amazing opportunity for entrepreneurs to build big, beautiful companies.
I'd say that being able to acknowledge where your shortcomings are is a true strength. And I think a lot of the time founders are afraid to say, I know that my idea is bad in these areas because they don't want the VCs to find out. Spoiler alert, we're going to look and we're going to find it. So being upfront about this is my idea, this is how good I think it is now, these are the areas that are currently need work, and this is how I'm going to work on them is an amazing pitch. If you're open to showing where your idea is limited, that's a great signal for VCs that you're going to be easy to work with long term, and is a good sign for us.
I'll actually give you my thoughts as a two-time founder turned VC, and I'll tell you that being a founder is the worst way to build wealth. So you should know that going into it, and in spite of it, if you want to be a founder, go right ahead, right? But do not be under the misconception that it will help you create wealth, right? It is the worst possible way to create wealth. And the second thing is raising money is hard for anyone and everyone, including people, it was hard for me when I was a founder of a public company raising second time, right? I think raising money is always hard. But let me just tell you that your life as a founder through the life cycle of your company is going to be way harder than what you see in the beginning when you're raising money. So just think of the raising money as kind of like a test of whether or not you're going to have the wherewithal to do the rest of the journey, which is going to be 10 times harder.
So you took my thought, and I'm like, okay, but I will add to that, and I am going to make an assumption. I'm rooting for all of you in making the assumption that you're going to get funded. It's going to be really friggin' hard, but you're going to get funded. Now the work begins, and you've just sold this vision, and I've seen a lot of, you've sold on the vision, and I've seen a lot of founders then execute or not based on the vision and not on where they actually are versus where they need to get to. So congratulations, you've set. Now it's your time. The work begins, and execute on that vision to get to that next stage of growth, and again, to build that really healthy, impactful, successful, incredible venture.
Excellent. Thank you.
Once again, let's give it up for our panel. Come on. Let's give it up for Roger, our awesome moderator. So let's hear it for Procopio and all our sponsors. Let's hear it for our event team and our video team. Let's hear it for Joe, our bouncer. Let's hear it for our audience. Let's hear it for me. So stick around, network, socialize, connect, talk to the panel, take some selfies. We broke out the ice cream. Originally, we had 3 options for the after party. Once again, the Rosewood. It's a Thursday night. The patio. Or Pizza My Heart. The winner is... Actually, we're going to stay here. We got special permission from Roger. We can stay here all night. So enjoy the after party. Thanks for coming. Applause.